There is a building in the Mid-Wilshire neighborhood of Los Angeles that looks like it could house a dental practice or a mid-tier insurance brokerage. Beige stucco, surface parking lot, no glass tower, no logo you would recognize from a Super Bowl commercial. If you drove past it on your way to somewhere else, you would not slow down. You would not remember it. Inside that building, a man who is worth more than $7 billion runs a financial empire that touches millions of American lives. His name is Don Hankey. Forbes puts him on the same list as Bezos and Musk and Zuckerberg. And yet, if you stopped 100 people on the street, even in Los Angeles, the city where he has lived and worked for decades, not one of them could tell you who he is. That is not an accident. That is the plan. To understand Don Hankey, you have to understand a single structural fact about the United States. In most of this country, you cannot hold a job without a car. The bus doesn't come. The train doesn't exist. The ride takes 2 hours each way if it comes at all. You need a car the way you need shoes. It is not a luxury, it is the minimum equipment for participating in the economy. And if your credit score is below 620, if you went through a bankruptcy, if you are 22 years old and have never borrowed a dollar in your life, the bank will not give you a car loan. The bank will not even return your call. Into that gap, between the need for a car and the refusal of the bank, stepped Don Hankey. And what he built there is one of the most profitable and least visible financial empires in modern America. Little is publicly known about Hankey's early years. He was born around 1943, grew up in Los Angeles, and the biographical record before the late 1960s is nearly blank. Not because the information was lost, but because Hankey has never offered it. He is a man who does not give interviews about his childhood. He does not tell origin stories on podcasts. What is documented is that he entered the auto business young, working in dealership finance, and that he recognized something the banking establishment had either missed or deliberately ignored. The people the banks would not lend to were not all bad bets. Many of them simply had no track record, no second chance, no path back in. He started in the buy here, pay here model. A dealership finances the car directly. No bank involved. Interest rates set by the dealer. This was not new. Small-time operators had been doing it for decades, mostly as a hustle, mostly at a single lot. What Hankey saw was not the hustle. He saw the system. He saw that if you priced the risk correctly, if you charged interest rates high enough to absorb the defaults that would inevitably come, you could make money consistently, at scale, on the population the entire banking industry had written off. And here is the part that matters. He was right. The company that became the engine of everything is called Westlake Financial Services. Headquartered in Los Angeles, it operates as one of the largest subprime auto lenders in the United States. Westlake does not sell cars directly in most cases. It operates as an indirect lender. It buys the loan contracts from thousands of auto dealerships across the country. You walk into a used car lot in Houston or Atlanta or Phoenix. You pick a sedan, the dealer runs your credit and sees a 520 score, and the dealer calls Westlake. Westlake says yes. You drive away, and from that moment, your monthly payment goes to a company most Americans have never heard of, controlled by a man whose face you would not recognize. The interest rates are not what you are used to hearing about. They are not 5%. They are not 8%. On subprime and deep subprime auto loans, rates routinely run from the high teens to above 20% APR. On some loans, above 25%. The precise rates vary by borrower, by vehicle, by term length. But the range is documented in the asset-backed securities filings that Westlake submits to the SEC. Those filings exist Because Westlake does not just hold the loans. It bundles them, hundreds, thousands of loans at a time, into bonds, and sells those bonds to institutional investors, pension funds, insurance companies, maybe yours. That securitization process is the same structural mechanism that, in the mortgage context, contributed to the 2008 financial crisis. It has not produced a comparable crisis in auto lending, but the architecture is recognizable. And it means that the subprime auto loan market is not some back-alley operation. It is institutional finance, documented in SEC filings, rated by agencies like Kroll and DBRS Morningstar, purchased by the kinds of investors who manage retirement money for teachers and firefighters. Now, imagine you are on the other side of this transaction. You are a borrower. You needed that car. You had a 520 credit score because 3 years ago you went through a divorce and the medical bills from your daughter's surgery destroyed your credit. No bank would touch you. Westlake said yes. You drove away. You got to work. You kept your job. But the payment is $480 a month on a car worth $14,000. And by the time you finish paying, if you finish paying, you will have spent close to $28,000. The car will be worth $3,000 by then. And if you miss 2 payments, there is a reasonable chance you will wake up one morning and your car will be gone. Repossession is a private civil action in most states. No police, no warrant. A flatbed truck in your driveway at 2 in the morning, a winch, and then you are back to needing a ride to work. The question, and it is a real question, not a rhetorical one, is whether you are better off with that loan or without it. Serious economists split on this. The access argument says yes. Without the loan, you had no car, no job, no income. The high interest was the price of entry, and entry is better than exclusion. The debt trap argument says no. The loan at 22% on a depreciating asset creates a cycle. You pay, you fall behind, the car gets repossessed, you lose the equity you put in, and you start over with an even worse credit score, borrowing again at an even higher rate. Both arguments have empirical support. Neither is settled. Don Hankey, in the limited public statements attributed to him, has positioned himself on the access side. He has said in interviews that he believes giving someone a car loan when no one else will is giving them a chance to rebuild their life. The banks, he has suggested, are the ones who abandoned these people. He stepped in. The Consumer Financial Protection Bureau saw it differently. In 2015, the CFPB took enforcement action against Westlake Financial Services and its affiliate, Wilshire Commercial Capital. The findings were specific. Westlake's collectors had called borrowers' employers to pressure them into making payments. They had called family members and personal references. They had made unauthorized withdrawals from borrowers' bank accounts, pulling money without permission. These were not allegations. They were findings in a federal consent order, a public document. The companies were ordered to pay $44.1 million in refunds and penalties. $44 million. That number sounds large until you hold it against the scale of the operation it penalized. Westlake's outstanding loan portfolio runs into the billions. The annual revenue generated by the interest payments on that portfolio dwarfs the penalty. The federal government's largest enforcement action against the company amounted to what the operation likely generates in a matter of weeks. Consumer advocates have argued that penalties at this scale are not deterrents. They are line items. The cost of doing business, absorbed and moved past. Beyond the CFPB action, Westlake has faced a steady volume of consumer complaints through state attorneys general and the Better Business Bureau. The complaints follow patterns: aggressive collection calls, disputed loan balances, repossession procedures that borrowers say were premature or improperly handled. Each complaint represents one side of a dispute, but the volume and consistency tell their own story. And here is the thing you need to understand about the interest rates, because most people assume there must be a law against them. In most states, there effectively is not, at least not for auto loans. State usury caps either exempt auto financing entirely or set ceilings so high they are irrelevant to the actual market. California, where Westlake is headquartered, has historically permitted high rates on auto loans under the California Finance Lenders Law. These rates are not illegal. They are not even unusual. They are the market. He didn't break any rules. The rules were written to allow exactly this. What Hankey built with the proceeds is where the story turns and where it refuses to simplify. The Hankey Group is a privately held constellation of companies. Westlake Financial at the center, surrounded by Hankey Capital for commercial lending, multiple auto dealerships in Southern California, Knight Insurance Group, real estate holdings documented in Los Angeles County property records, and more. Because it is private, the Hankey Group does not file public financial statements. There are no quarterly earnings calls. There are no activist investors demanding transparency. There are no reporters on a regular beat covering the company's operations. The estimated $10 billion in managed assets is a figure that appears in profiles and industry reporting, but no audited number is publicly available. This opacity is not incidental. It is structural. Private companies face less regulatory scrutiny, less media scrutiny, less pressure from every direction. By keeping the empire private and himself out of sight, Hankey operates in a zone of American capitalism that is legal, immensely profitable, and almost entirely unaccountable to public attention. He is not alone in this. Several of America's largest fortunes belong to people most Americans cannot name. But the contrast between the scale and the anonymity is unusually stark. Forbes has called him one of the least known billionaires in the country. He does not attend industry conferences. He does not appear on cable news. He has no verified social media presence. He reportedly drives unremarkable cars. The man who lends money to everyone the banks refuse became richer than most of the bankers who said no. And then he started giving it away. Don Hankey has donated hundreds of millions of dollars to medical institutions. His gifts to Cedars-Sinai Medical Center in Los Angeles have been among the largest in that hospital's history. The Hankey family name appears on facilities and programs there. He has made major gifts to UCLA Health. Forbes has reported that his lifetime philanthropic giving exceeds $400 million, primarily directed at healthcare and education. In the limited comments attributed to him, Hankey has framed this giving in personal terms. Motivated, it is reported, by family health experiences. He has not signed the giving pledge. He has not held press conferences about his generosity. The institutions themselves confirm the donations. Hankey does not promote them. If you are looking for the moment in this story where the moral picture resolves into something clean, this is not it. This is where it gets harder. Think about the money. Follow it backward. A borrower with a 520 credit score in Phoenix finances a used Nissan Sentra at 22% APR because she needs to get to her shift at a warehouse distribution center. She makes her payments for 3 years. The interest she pays flows to Westlake Financial Services. Westlake's profits flow to the Hankey Group. The Hankey Group's founder writes a check to Cedars-Sinai Medical Center. Cedars-Sinai buys a piece of imaging equipment that diagnoses a tumor in a patient who walked in off the street. The interest payments from people who couldn't get a loan anywhere else became hospital wings where anyone can get treatment. That is not hypocrisy in any simple sense. It is a circuit. one that runs through the specific architecture of American capitalism, where the regulatory framework permits high-interest lending to vulnerable populations, where the profits from that lending are taxed and donated under favorable rules, and where the donations fund institutions that serve the public. Every piece of that circuit is legal. Every piece of it is, depending on where you stand, either a system working as intended or a system that has failed the people it claims to serve. If you have ever financed a used car, or if someone in your family has, a son or daughter just starting out, a parent rebuilding after a setback, there is a meaningful chance that the loan was originated or serviced by a company inside the Hankey Group. You would not have known. The paperwork would have come from a dealership you recognized. The monthly statements would have carried the Westlake name, which means nothing to most people. The man behind it all would have remained exactly where he prefers to be. Invisible. And that invisibility is not just personal preference. It is competitive advantage. In an age where billionaires compete for attention, Hankey competes for its opposite. And winning that competition is part of how the empire works. Public companies face analyst calls and shareholder lawsuits and investigative journalists with quarterly deadlines. Hankey faces none of that. The CFPB action in 2015 was the single most visible moment in the company's history. A brief flash of public accountability, and it passed. The machine kept running. There is no tidy way to end this story because the story is not over. Don Hankey is alive. The Hankey Group is operating. Westlake Financial is still among the largest subprime auto lenders in the country. The borrowers are still borrowing. The interest is still compounding. The bonds are still being sold to institutional investors. The hospitals are still receiving donations. The next time you are on the 405 in Los Angeles, sitting in traffic, look at the cars around you. Thousands of them. Sedans, SUVs, pickup trucks, driven by people going to work, picking up their kids, living their lives. Some unknowable fraction of those vehicles carry a loan serviced by Westlake Financial. The drivers do not think about where their payment goes. They think about the payment itself, whether they can make it this month, whether the car will last until the loan is paid off, whether the math will work. Somewhere in the mid-Wilshire neighborhood, in a building you would not look at twice, a man who is worth more than $7 billion already knows the math works. He has known for 50 years. What you make of that? Whether this is a story about access or exploitation, about generosity or extraction, about a system that serves people or a system that uses them, that is yours to decide. The numbers are on the public record. The CFPB filings are archived. The ABS prospectuses are on the SEC's website. The donation plaques are on the hospital walls. The used Nissan is still in somebody's driveway, and the payment is due on the 1st. If you have encountered this world, as a borrower, as a dealer, as someone who has watched a family member navigate bad credit and no options, we want to hear about it. Tell us what that looked like from where you were standing. And if you want to understand more about the financial structures that shape American life from behind walls most people never see, stay with us. There is more to find.